In this week's video, we'll cover a sector that tells us to be open to enormous upside in stocks over the next several years. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We'll kick off the video by reviewing some charts that tell us to keep an open mind about better than expected outcomes, and then we'll review some incredible looking sector charts. We'll end the video by putting some numbers in dollars around risk versus reward. What happens if the charts are wrong and worse than expected outcomes are what we have in front of us over the next few years? And what happens if these charts are correct and the next few years are marked by much better than expected outcomes? Let's take a quick look at history and compare it to the present day. That'll give us some idea of potential upside in the coming years. This is the NASDAQ Composite Stock Index from 1982 to 1991 here. The NASDAQ entered this box in calendar year 1985 and was still inside the box as of March 25th, 1991. Resistance, 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 potential resistance. And then on May 31st, 1991, we had a bullish breakout out of the box. And we know that the longer we go sideways, the bigger the move that we can expect to get when we either get that bullish breakout or bearish breakdown. The purpose of showing this chart here, we have many charts in the present day that are similar to this chart. Let's assume back in 1991 that we were skeptical about this breakout. What happened next, and what potential upside could we have missed if we remained skeptical? This is the same 5-year period and the same orange box. The longer we go sideways, the bigger the move that we can expect to get. In this case, after the bullish breakout, the NASDAQ gained an eye-popping 965% from point A to point B. Similar situation here is a bullish breakout, March 25th, 1991 in the S&P 500. Remember, a lot of charts in the present day look like this. What would have happened in 1991 if we were skeptical of this bullish breakout? It's the same orange box here. And after the bullish breakout, the S&P 500 gained 323% from point A to point B. The concept of fractals applies to the stock market, which tells us that any pattern that we're comfortable with on a shorter-term time frame applies to a longer-term time frame in the exact same manner. Not a similar manner, the exact same manner. We're all familiar with the term, the market needs to consolidate its gains, or the market has gotten ahead of itself. So what happened to the NASDAQ after the year 2000? It did exactly that. It went sideways and consolidated its gains and ended up staying inside this orange box for 20 years. The longer we go sideways, the bigger the move that we can expect to get. The longer we go sideways, the bigger the move that we can expect to get. Market fractals tell us if this box was significant, this consolidation was significant, and it's also possible that this box and this consolidation will be significant after what appears to be a bullish breakout. And you can see price was very indecisive here at the top of the box and finally decided to move higher after the U.S. election. It really doesn't matter how you draw this box. We're talking about a concept of indecisiveness or a concept of consolidation. It's an indisputable fact that price went nowhere from point A to point B here for 12 years. Absolutely nowhere from point A to point B for 13 years. And absolutely nowhere if you bought here at point A, you are back to break even at point B. We can't draw any lines like that during this period here. This period here really doesn't look anything like this period here. This period here looks a lot like this period here, It's just a much longer period of indecisiveness and consolidation. Remember, we said it could have been very, very costly to be skeptical of the facts in hand in 1991. The look of this chart is very similar to the look of this chart and the look of this chart. This is a 19-year, basically sideways pattern where not much has happened in the NYSE composite, and we have in the present day what appears to be a successful and retested bullish breakout. And if we zoom in even closer, we're also coming off a 3-year period of consolidation. The longer a market goes sideways, the bigger the move that we can expect to get. If you're familiar with technical analysis and chart patterns, it'd be relatively easy to answer a multiple choice question on a test. If we were presented with this chart and this look here on a multiple choice test, and it said, most likely from this point here, price will move a long way in this direction, price will move a long way in this direction, or none of the above, we would pick, from an odds perspective, that price would move a long way in this direction. This is a consolidation box and a breakout here that seems to be holding. The flat look of the moving average in here also tells us that we had a long period of indecisiveness. It's also important to keep in mind, despite this move here, anyone that entered this investment here was at a loss for this entire period, and they just got back to break even at this point here. So instead of being a rip-roaring bull market, this is a long period of consolidation and a long period of frustration for anyone that bought in this area here or here. We've been looking at a long-term chart of SMH, which is the Semiconductors Etf. This is calendar year 1998 on the left side of the screen and 2017 here. Price entered the box sometime in 1998. This ETF wasn't around. Hit the top of the box in the year 2000, the bottom of the box in the year 2009, and has now just exceeded the top of the box in calendar year 2017. The longer we go sideways, the bigger the move that we can expect to get. It's very, very difficult to look at this chart and not be open to the potential for enormous upside in semiconductors and basically in stocks in general. This is a very, very important part of the market, and if semiconductors are healthy, typically that means all 3 major indices in the U.S. would be healthy as well, especially tech stocks. It's important to revisit the title of our video. The video says be open to. It's not predicting or forecasting anything. It's simply saying, based on this chart as of May 31st, 2017, we should be open to enormous upside in semiconductors over the next several years. It really doesn't tell us anything about what's going to happen over the next few days, next few weeks, or even the next few months. This is a long-term breakout, and it helps us with longer-term probabilities. The longer we stay above the orange box, the more meaningful it becomes. We also learn something if the breakout fails. That would be something we would learn on the bearish end of the spectrum. Let's just quickly flip through some other semiconductor stocks. Advanced Energy Industries has been inside the orange box for 20 years. As of March 31st, 2017, it was still inside the orange box. If we fast forward to month end, May 31st, 2017, and this is a monthly chart, we have what appears to be a 20-year breakout. We have finally exceeded this high from calendar year 2000, and we finally left the box that price entered 20 years ago. Similar situation with Applied Materials, April 28th, 2017. We were still inside of the orange box and had not yet exceeded the highs from the year 2000. If we fast forward to month end, we closed above the orange box. The longer we hold above it, the more meaningful it becomes. Similar situation for Texas Instruments. It entered the box here and then stayed in the box for 19 years. Look at the sideways movement here in the 50-month moving average. The longer we go sideways, the bigger the move we can expect to get. Taiwan Semiconductor was inside the orange box here for 16 years. It consolidated and moved, consolidated for 2 years, and then had a bullish breakout. Nova Measuring Instruments finally was able to break out of the orange box. It was inside of the orange box for 16 years. This chart is as of May 31st, 2017. The concept of consolidation speaks to frustration. If you bought ticker symbol NVDA in 2001 at this point here, you were simply back to break even at this point here in calendar year 2015. This is also a constructive looking long-term chart on June 1st, 2017. Lam Research, resistance rejected, resistance rejected, resistance rejected, bullish breakout, a retest here. What once was resistance may now act as support, consolidation, and another breakout. This chart looks good as of May 26, 2017. KLA Tencor was in the box for 20 years. Now it's above the box. Brooks PRI Automation was inside of this orange box for 14 years. Now it's above the box. Remember, market fractals tell us that all of the concepts that we've covered in these videos on shorter term time frames apply to longer term time frames, including the 3 steps needed for a trend change, at least from a probabilistic perspective. Step number 1, we have to break a trend line. We did that in calendar year 2010. Step number 2, we have to make a higher low relative to the previous lows. This is a higher low here relative to this low and this low. And step 3 is making a convincing higher high above these highs here, which we have done in calendar year 2017. This chart, like all of the charts we covered, this chart cannot predict the future. It simply helps us with the probability of good things happening relative to the probability of bad things happening. ASML, ticker symbol, semiconductor, entered the box here, left the box 15 years later, then consolidated for 3 years and recently broke out of this consolidation pattern. This chart is as of June 1st, 2017. Let's shift gears to our risk versus reward bullet point. Keep in mind, if I have $500,000 or $1 million in cash, I also have an opportunity cost risk or a risk associated with doing nothing. If we have our capital invested, how can risk be prudently mitigated? You can't eliminate risk. You can only mitigate and manage risk. When we have our capital invested, it's always prudent to look at the worst case scenario. So let's say in the present day, over the next few months, the market starts to morph into a look like this. This is right before really bad things happened in the S&P 500 in calendar year 2000. And this is right before really bad things happened in calendar year 2008. We can see the market has a full-bore bullish look over here, and it morphs over time. It takes several months to morph into a full-bore bearish look, but we can see it, we can measure it, we can put it in a model. We can see it, we can measure it, we can put it in a model. This helps us assess probabilities. How does the present day look? Does it look anything like this concerning rollover look here or this concerning rollover look here? The answer is absolutely, positively no. The present day, as of the close on Friday, June 2nd, 2017, this doesn't look anything like this concerning look here, and it doesn't look anything like this concerning look here. Notice when bad things are about to happen, price tends to congregate near the moving averages. This is indicative of a weakening trend. Price tends to congregate near the moving averages for several months. This is indicative of a weakening or waning trend. Look where price is in the present day. This looks like a very, very strong trend. Is it possible this morphs into something like this? Absolutely, positively, yes. But most likely it will take time. It will take at least several months to morph into a long-term rollover look. If we maintain that maximum flexibility, we can adjust as needed when the facts in hand change. The important thing is they haven't changed yet, telling us to remain fully invested. The model uses the weight of the evidence, and there's numerous ways to monitor hard data and evidence relative to the market's risk-reward profile. Last week we talked about monthly MACD. This is the look we want to avoid before really bad things happened. This is the type of look that we want to embrace. How do we look in early June of 2017? Does it look more like this, or does it look more like the embrace look? The answer is easy. This is the exact same indicator, monthly MACD for the S&P 500, June 2nd, 2017 at 11:54 a.m. The present day doesn't look anything like this rollover look here or this rollover look here. And let's put some numbers around the potential reward in this type of environment. Another do-nothing argument is, well, I can't invest my money when the market's making new all-time highs. You could have made that argument in 1982. You could have made that argument in 1985. You could have made that argument in 1989, 1992, 1994, 1996, 1997, 1998, 1999. Had you made that argument and not invested any of your capital, you would have missed one of the greatest bull runs in stock market history. As we've covered in these videos in the past, a new all-time high doesn't tell us anything at all about the market's risk-reward profile. We've already covered that the present day is somewhat similar to this period here, and you can make an argument it's even more attractive because our consolidation boxes are much longer than they were here in calendar year 1990 and in 1991. To get a better idea of the potential reward, let's assume that we took 20% of our $1 million and invested it in the NASDAQ here after the bullish breakout. And for hypothetical and illustrative purposes only, let's also assume that we took the remaining 80% and invested it here in the S&P 500 in calendar year 1991. So what would the hypothetical growth of a portfolio invested 80% in the S&P 500 and 20% in the NASDAQ have looked like had we been invested 80-20 in June of 1991? This is what our portfolio hypothetically would have looked like. $1 million would have grown to over $5 million in calendar year 2000. And with the benefit of hindsight, these type of things seem easy, but we know from past videos that the market will never make anything easy on anyone, and this is an emotional roller coaster between point A and point B. Let's assume I were 51 years old in 1991 and I had $1 million. Option A is to sit on the money and be conservative. Option B is to invest the money 80% in the S&P 500 and 20% in the NASDAQ. Had I done that, my $1 million over just a 9-year period would have grown to over $5 million. The difference between having a $1 million portfolio and a $5 million portfolio is very, very significant relative to quality of life. If I take a 4% draw or 4% annual income off a $1 million portfolio, I would get $40,000 a year in income. If I take the same 4% annual draw or annual income off a $5 million portfolio, instead of taking home $40,000 a year, I'd be taking home $200,000 a year, hypothetically. We all know there's risk and uncertainty involved in investing, but we also have to acknowledge there's risk and uncertainty, potentially huge risk and uncertainty, by doing nothing with our investment capital or sitting on the sidelines or pulling our investment capital from the market, hypothetically, if we did it in 1991. As we noted, the market never makes it easy on anyone, and to capture that hypothetical gain of 965% in the NASDAQ from June of 1991 into the spring of 2000, you would have had to withstand a lot of volatility along the way. It's very, very difficult to get from point A to point B. Regular viewers and clients know that the model, using trend following techniques, can help us smooth out this volatility. While price was very, very volatile between point A and point B, the 50-month moving average had a nice positive and bullish slope during the entire move. It can be very, very difficult to make decisions based on volatile price alone. It's much easier to make prudent and rational decisions using trend following techniques or hard data as the model does. The benefit of hindsight, this looks very, very easy looking at this moving average to capture the gain from point A to point B. Similar situation over the same period we've discussed. The 50-month moving average was pretty solid between June of 1991 and the spring of 2000. From a weight of the evidence perspective, it's important to note that not only are good things happening in the United States, but they're happening around the globe. Here's one example. The London Financial Times Index entered this box back in calendar year 1995. It stayed inside of the orange box for 21 years and recently broke out. There's a couple of things that we can learn from this particular chart. Harder markets are often followed by easier markets. If that's the case here, we are very, very early in the easier markets period after a very long, harder market period. It should also be noted, things have been unsettled until very, very recently. This particular chart had not broken out yet late in calendar year 2016. Here's the U.S. election here. Why is some caution warranted here? Because when you're at the top of the box, it's possible to go to the bottom of the box. When you're at the top of the box, it's possible to move back down near the bottom of the box. It was possible here, or even here, if this resistance remained in place, that markets were going to move back down to the bottom of their boxes. Remember, the longer we stay above, the more relevant it becomes. Many of these breakouts have been above their boxes for some time now, which aligns with the weight of the evidence, which tells us the probability of good things happening is quite a bit better today than it was really at any time inside of these boxes. How do we handle things going forward? The exact same way we've handled them over the past 9 months or so. We always ask, are we allocated properly based on the facts that we have in front of us today? If the answer is yes, or we're not sure, we leave it alone. If the answer is no, we make some adjustments to get back in line. In terms of the where do we go from here, it might be helpful to look backwards. Remember, if we look back 9 months, things were still fairly unsettled in here. But as we've covered in our videos over the past 9 months, 9 months ago, 8 months ago, 8, 5 months, 5 months, 4 months, 2 months, 3 weeks ago, and 5 days ago, and these are just a sample of the videos that we've published over the last 9 months, all of them have told us to be open to better than expected outcomes. So 9 months ago, when this video, this signal has only occurred 10 times in the past 35 years, was published, it told us to be open to better than expected outcomes. We weren't predicting anything. This is the S&P 500 roughly 9 months ago. Being open to better than expected outcomes was helpful. The market improved from here to here. And as these videos indicated, the facts in hand continually told us to be open to better than expected outcomes. And if we fast forward to just 2 months ago, the facts that we had in hand were helpful. The hard data has been telling us to keep an open mind and try to remain patient. 3 weeks ago, things still look good. And if we fast forward to June 1st, 2017, we can see that the concept of using hard data to manage our allocations has been helpful. And keep in mind, we're still in a harder market area in here, looking back 9 months. Now we have moved into, based on the facts that we have in hand, an easier market. How long will that last? The answer is we have no idea. We'll continue to do the same things. As we go forward, we'll continually ask, are we allocated properly based on the facts that we have in hand? Charts cannot predict the future, and we are not forecasting or making any predictions here. Remember, the title said, be open to enormous upside in stocks. If you know charts and you know technical analysis, this chart is telling you to be open to potentially enormous upside now that we're outside of this long-term consolidation box. If the facts in hand going forward tell us to maintain a growth type allocation, we will do so. If the facts change, we will remain flexible and make any necessary adjustments. We'll continue to take it day by day, week by week, month by month, and year by year. Two more anecdotal examples from history. 1989 to 1991, sideways, good things happen. Sideways here again, good things happen. It's never easy to get from point A to point B, and there are many common missteps and many things that can get us off track, and it's going to require, even if better than expected outcomes occur over the next few years, it's going to require an incredible amount of discipline to successfully navigate from point A to point B. And at some point, whether it's in 3 weeks, 3 months, 3 years, or 30 years, volatility to ignore will morph into volatility to respect. And the only way we can use the charts properly and the model properly is to maintain that all-important maximum flexibility 100% of the time. If the story and the charts change, we have to be flexible enough to adjust our allocations as needed. Our model has numerous inputs, and part of maintaining maximum flexibility is understanding what type of market you're in. This type of market is quite a bit different than this type of market. After a long period of consolidation, one of the best ways to produce big profits is by cutting down on the number of trades you make. Locking in profits makes sense in this box. Here, if anybody makes 965% from point A to point B, if they're not thrilled, then they really don't understand the markets. If we are in an environment like this, trading less makes sense, which is one of the reasons why we made some chess moves recently. Our current allocation gives us a much higher probability of trading less between point A and point B, and therefore a higher probability of capturing a higher percentage of the gain from point A to point B. The model has different inputs, and you have to understand which inputs work well in this environment and which inputs are more favorable or work better in an environment like this. This environment aligns very well with this Jesse Livermore quote that we go over and over again for a reason. It was never my thinking that made big money for me. It was always my sitting. Got that? My sitting tight. The moral of the story here is, if you're identifying long-term bullish trends, if you remain invested and ignore the volatility and can do what others find difficult to do, you can post very, very impressive gains. How does all this apply to the present day? These quotes apply to this type of market. And this type of market, marked by strong trends, came after a long period of sideways consolidation. If we fast forward to 2017, we have just come out of an extremely long period of sideways consolidation. And everything that we have in front of us today aligns with moving into a green box like this. Based on the evidence we have in front of us right now, we have moved from a harder market into an easier market box. We will manage based on those statements as long as the facts we have in front of us today align with that. As of June 1st, they still align perfectly. Therefore, if trading less and sitting tight during normal and to be expected volatility was helpful here, it will most likely be helpful in the years to come. Over the past several weeks and months, going back 9 months to the "this signal has only occurred 10 other times in the past 35 years" video in August of last year, we have presented an enormous amount of evidence that tells us to be open to better than expected outcomes for several years. Why are we currently fully invested? One of the great things about charts, this is a set of facts. It has nothing to do with an uncertain future. The set of facts that we have in front of us today, the weight of the evidence, tells us that we may have a wonderful opportunity going forward. We'll close in a different manner this week with some quotes about opportunity. We track all of this and convert it into a usable and actionable format in a reasonable amount of time. The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.